Welcome to the Sunday paper. The market saw a sell-off this week, with the S&P 500 dropping from a peak of 5651.37 down to 5402.62. On the SPY, that translated to a drop from $564.20 down to 539.44. A lot of the conversation discussing the drop centered around market sentiment, meaning investors and traders became sellers instead of buyers. This type of price action is all too typical around this time of the year, as August and September give negative returns 55% of the time, more than any other time of the year, and September gives worse returns than August. This has become known as the September effect, and although there are no clear reasons for it, market participants have a few theories as to why it happens. Investors end the summer by cashing out of positions that have massive gains in order to ensure they can return profits to shareholders, all the while building a cash position to get ahead of next year's trading by buying stocks in October. This could be supported by the data showing that October through December has an average return of 0.93%, while Q1 gives 0.53%, Q2 gives 0.78%, and Q3 averages a loss of 0.66%. Some companies also began tax loss harvesting at the end of Q3. Tax loss harvesting is a tax strategy whereby you sell your stocks for a loss, in turn lowering your earned income or capital gains tax by the amount lost, and you let your winning stocks or stocks you trust continue to go up without selling them until the next calendar year or whenever you're in a more tax advantageous situation. Remember, right now, only realized gains and losses are accounted for on taxes, so you don't pay taxes on stocks until you sell them. Gains and losses are considered unrealized or paper returns before you sell them. Last week, we got earnings from Broadcom, the third largest semiconductor company in the world and second largest in America behind Nvidia. Broadcom's net revenue came in at $13.1 billion, up 47% from this time last year when they reported revenue of $8.9 billion. But they reported a net negative income of $1.9 billion compared to positive income of $3.3 billion last year. That negative return in income precipitated a nearly 12% drop in Broadcom's share price, falling from $153.35 to $136.60 in one day. The entire semiconductor sector ended with the lowest total percentage drop across all sectors in the S&P 500, and their weighing on the index helped lead the market down to the $540 low we saw on Friday. The Fed meeting is still 10 days away, giving the markets plenty of time to continue to garner cash, build stock and bond positions, and prepare for what is expected to be the first rate cut of this market cycle. The CME Group's FedWatch tool gives a 69% chance of a 25 basis point Fed rate cut and a 31% chance of a 50 basis point cut, meaning the Fed overnight exchange rate could go from its current range of 5.25 to 5.5% down to as low as 4.75%. With that, CME is also beginning to price the probabilities of subsequent cuts for the rest of the year, with the lower range coming in at 3.75% by the end of 2024. Rate cuts have historically been a tool used by the Federal Reserve to stimulate the economy, encouraging companies and consumers alike to borrow more and banks to lend more. But is that the case right now? The JOLTS report, or the number of job openings in the country, was reported this week and came in weaker than expected at 7.7 million jobs available, as opposed to a projected 7.9 million. This decline in the number of job openings made many believe that the Fed has more reason to cut down to 4.75% with their first cut to stop a trend of weakening job creation before it fully develops. The non-farm payroll numbers, or the number of new hires in the country, was reported on Friday, and that number was also lower than expected. We received a headline number of 142,000 new jobs, 18,000 jobs lower than the expected 160,000, and a far cry from the 165,000 projected by a Bloomberg survey. Finally, we saw a drop in the energy market this week. The USO ETF, which tracks the price of oil in America, dropped 10% from $74.37 down to $67.91. Low prices in America and weak demand in China encouraged OPEC to delay their previously planned oil production increase. A decrease in supply could cause an artificial price increase in oil, but with the fall and winter months approaching in the northern hemisphere, the demand for oil could remain low for the next few months. And we saw the VIX move back above 20 this week. The VIX, officially the CBOE Volatility Index, measures the volatility in the S&P 500 futures market. It does this by calculating the differences between prices of the S&P 500 options contracts expiring on the third Friday of each month and the prices of the contracts expiring on all Fridays in the month, excluding the third Friday of the month, against the strike prices of all options contracts that are no less than 23 days and no more than 37 days out. The greater number of strike prices projected to expire above $0 in this time frame, the more expected volatility in the market, and since the two are inversely correlated, the VIX and the S&P 500, the higher the VIX, the lower the S&P 500 price. But all we need to remember is when the VIX is above 20, it's a good time to start buying stocks. Take a look at the 1 month, the 3 month, and 12-month heat charts of the S&P 500 and get ready for the next wave of the market cycle when the Fed begins the rate cutting cycle later this month.